Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the Federal Reserve and how the next Fed chair could impact housing. First, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
Happy Halloween, Sarah Wheeler.
Yay, I love Halloween. I love seeing all the little kids dressed up. It's going to be a fun day.
Yeah, I've had a lot of fun with AI and Powell and everything. And of course, when we're doing this podcast, it's Thursday morning. But as you can imagine, Treasury Secretary Bessent wasn't too happy with Powell. He applauded the rate cut, but he didn't like the language right away. And Thursday morning, pricing got worse still. It's about a 20 basis points move in 2 days. And anybody who's in the business understands, boy, when you get a swing like that, if anything is kind of floating, it could cause chaos for sure. But Powell accomplished what he wanted to do, and I think that's just how he is. But you get a lot of questions, like Jerome Powell said housing is weak, and yet he knew the actions he would do would push rates higher. So it's a legit question. Does the Federal Reserve hate housing?
I think it is a legit question. It's something that you've brought up, the fact that they don't care about housing because it's not part of their mandate, right?
Well, this goes back to Neil Kashkari. It was February of 2023. And mortgage rates were getting down towards 6%. Here we are. 2022 had the fastest crash in existing home sales ever.
Because of the fact that rates went up so
Rates
fast.
went up to 3 to 7. Then new home sales were falling, housing permits were going to fall, all this stuff. Mortgage rates just got to 6%, and Neil Kashkari, which I will never forget, went on national TV and he said, how are we supposed to balance an economy when mortgage rates are near 6% and housing shows a little bit of sign of life? There was your first clue and your last clue that how I described it. I remember going on CNBC later that year and saying it's almost like a COVID-19 policy. Suppress demand, suppress living, crush it until the labor market breaks. And then you could say, okay, well, now we would like to have the housing market come back and have housing permits grow and starts grow and jobs be created and get it going. But back then, even with 6%, and we were talking about like a little kick in demand by purchase application data, and they were frightened then. And whenever we get near 6%, they come out here swinging, right? They're trying their best. Now, it's Thursday morning. The 10-year yield's at 4.9%. That's much different than what we had in 2023 when we peaked around 5. But to me, their mandate is price stability and employment. And there's a lot of discussions about how they view employment, but construction workers are losing their jobs, especially contract construction workers are losing their jobs. Manufacturing jobs have been lost since the end of 2022, which nobody wants to talk about. I keep on putting that chart up there and I go, why does anybody else want to show this chart? But for housing, they feel like that's all they can really control. Like there's not much, like, Powell got these questions about, well, do you think that lowering rates will create an AI boom? Like all this spending will happen because rates go down? I was like, no, man, people are throwing in money like crazy. This isn't like eToys and, Lycos and those stocks in the late 1990s that didn't have any earnings. And these are the most powerful, prolific companies in the history of the world. They have lots of money and they're just pouring it down. It doesn't matter if the Fed funds rate is here or here, but for housing, they think that's all they can control out there. And this is why it seems like whenever rates get down here, they push back on it.
So that was one of my questions, is why is housing sort of the sacrificial lamb, right, in this? Is that because if people buy houses, then they're going to buy other stuff and that's inflationary? Like, what is the point?
What have I always said, Sarah? If people start buying homes, they're going to have sex, they're going to have kids, they're going to buy more stuff. right?
Right.
And that is the consumption rate model of housing, whatever the multiplier impact that people want to put. And then, we start building homes. And then when you build more homes, you get more people employed and more people are working, and then you big ticket items, right? You get big ticket items because you got to put all those big ticket items into the new home sale model for how they component GDP. So if this is the only thing they have and it works here, yeah, they're going to. And this is why you don't hear any real comments. You think about it's really interesting. We've had the fastest crash in home sales. Existing home sales are near record lows if you adjust it to the population. I can make the case that we're near 5 million home sales and we're missing 1 million mortgage buyers. But in any case, new home sales are low enough to where housing permits are at recessionary levels. Housing starts at recessionary levels. Some of the Fed governors have brought this up that, this is the time where you actually want to become a little bit looser. You don't need 3, 4, or 5, but they freak at 6 because I think they feel like this is all the control they really have. And they want to, save this silver bullet for the recession werewolf that when they need to shoot it, they'll do it then. But I understand, especially what happened yesterday. But what Powell did yesterday is what a lot of Fed people have done in the past. When rates get down to 6 and they are still modestly restricted, like in the past, they were still hiking rates in 2023. So that was a whole different ballgame. But now, even with the labor data where it is, this is all they got. So they have to keep this, elevated. I think that they are so petrified. If home sales start to grow and housing starts to grow, and construction picks up again and permits, these things are inflationary because they expand an economy. So I think that's just part of the where it seems like they're always against the housing market. Whenever you get a little bit of rates lower, they go with it. And that's just the world we live in. And I picked this up 2023 when Kashkari said that on national TV.
Okay, well, let's press into this a little bit in the idea that, like, at some point, right? So we know that Bessent is going to be sending the final 5 or he's sent the final 5 to Trump, and Trump is going to pick someone by December. So let's talk about whoever he picks. Like, I had someone, just a civilian, we'll call them a civilian, not in the business, yesterday ask me, if Trump gets to pick the next, whoever he picks for the next Fed chair, does that mean we're going to see mortgage rates just go way down? And I think that's a legitimate question. If you don't follow this, you're like, okay, so he wants lower rates. He gets to pick the next Fed president. Does that mean we're going to get significantly lower rates once that person's in?
Well, I would tell you this. Let me give you a hypothetical. I am, let's just say, Kevin Hassett. Kevin Hassett is the economic chairman for the White House. He's one of the 5. Let's just say Kevin Hassett was the Fed chairman yesterday. Do you know what he would do? He would say, we believe we need to press from this modestly restrictive policy, press away from it and get to neutral, to where we need to be accommodative. We believe that we are too restrictive. Imagine if Powell said that yesterday.
Yeah.
Okay.
10-year yield would have.
I mean, it'd be different. We wouldn't have, I don't think yields would go tremendously lower, but it would be different. There is limits to what you can do still as a Fed chairman, because everyone has to agree. So I wouldn't say that rates are just going to go shooting down, but the language, this is what Treasury Secretary Bessent was angry about, the language that Powell used, right? He said, we're getting a new Fed chairman by Christmas, right? By Christmas out there. Think about it. President Trump is going to give the American public a Christmas present by a new Fed chairman, right? It's always theatrics with it, but that's what's going to happen. And the marketplace will anticipate that we're never going to hear that anymore. And like I've always said, the days of Powell worshiping his little, power trip on that podium will soon come to an end. And the next person will basically have a more dovish stance. This doesn't mean the 10-year yield is going to collapse and mortgage rates are going to collapse, but it's going to facilitate a much smoother marketplace down toward neutral policy. If the labor market was breaking, all bets are off, because we've never talked about what an accommodative policy is. That's a whole different dog. You can get the Fed funds rate to 1.5 to 2.25 and be accommodative without getting to zero interest rate policy. We've never discussed that. That's where mortgage rates could get to the low fives and mid fours. We're not anywhere near there, not yet. But a different Fed chairman would not have said that, or any of the five that are in the runnings for Christmas present for the American people, the end of Jerome Powell's tenure at Fed chairman.
I mean, just to be clear, his tenure goes through May.
It goes to
So,
May, but again, once you get somebody picked, everyone. I always tell people this notion of bond vigilantes, that there's a bond trader out there that goes, I hate government spending. I'm going to sell my 10-year yield because I'm going to show and everyone's like, the Fed's cutting, homie. I don't care. Okay, bye. Oh, by the way, that person's fired by the end of because
right.
65 to 75% is still Fed policy. So in any case, this is Powell probably has one more meeting left before now they're going to announce it in Christmas. But whoever it is probably not going to say what he did yesterday. I could just imagine Pulte, Trump, and Bessent were really pissed off about that statement, because Powell really went out of his way to make sure to let everyone know that this is not going to be, don't put all your eggs into a basket. It's not a foregone conclusion about the rate cuts. And, when we get down to these levels, this is where they push back.
So, I've heard a lot of predictions for 2026 already, right? Rate forecasting. I have not heard NAR's yet. So their annual meeting is next week, 2 weeks. So we haven't gotten theirs. And a lot of times they are actually more bullish than anybody else. They'll have lower rates than maybe other people. But so far, nobody that I've listened to, no organization has said, expect rates even in the fives. They're still pretty like 6.25 or whatever. And I think, couldn't that change significantly if you had a different Fed chair?
Not really. It really depends, because it depends on, what did Trump want to do? Trump wanted to put more of his people in. So then you can actually, when you have more voters and the Fed chairman, you could bully ball the rest of the people on the committee. So you have to see the composite of everything. Now, for me, generally, I always wait to the very last day of the year, take a look at the economic landscape. We don't target mortgage rates. We target where the 10-year yield can go within a cycle with Fed policy, and what can or can't move it up and down, right? We don't target mortgage rates. But if Trump gets more of his people in and he gets the new Fed chairman, bully ball, right? Whatever is left, the Beth Hammocks of the world, or all who might say something, the voting block is going to be different out there. But you need a ringleader first. So again, it'll be interesting who Trump picks. The theme of this podcast could even be, will the next Fed chairman be pro-housing, right?
Yeah.
That 100% sure, right? Because if Warsh and everyone else is talking about we have to help the housing market, you could realize Powell is the last, bane and strife to this whole story. That even in this last day, you really had to, get his little punches in before it's coming to an end. And so I think it'll be a much more positive backdrop. But of course, anyone will have access to sub 6% mortgage rates. Like right now, when you think about the ARM loans compared to the 30-year fix as of today, when the pricing gets up on the long end side, those ARMs even look better, right? So it's going to be a really interesting 2026 on so many fronts for housing, but definitely 100%, whoever the next Fed chairman is out of the five will definitely be a more pro-housing Fed chairman than what Jerome Powell was since 2022.
Even your own housing market forecast for this year under mortgage rates, right? You have a range, which is based on your range for the 10-year yield, and the mortgage rate range is 5.75. up to 6.5,
5.75 to 7.25, but
7.25.
also I variable put the spread index into it. So
Right.
this is again, I should be a mortgage spread right now. I couldn't find, Wonder Bread and a big knife of jelly to put all over myself. Boy, that would have been a sight today. In any case,
No.
mortgage spreads last year on average was 2.54%. I had a 27 to 41 basis point improvements on a year-over-year basis. I think we got to 39 or even 40. So we pretty much got there. I incorporate all those things and figure out where we are in a range. If mortgage spreads were back to normal on the high end side, we're there already. We're at 5.7.
But we're where?
We're at 5.75. We already got there. But I didn't predict that, so I can't really go there. If I'm wrong, we would have got there already. So we're getting closer. It's nothing bad. But with the 2 rate cuts in, if we had no tariffs, see, this is an interesting question. I've always said that even if we didn't have any tariffs, we would have only got 2 rate cuts. Because the Fed was always talking about, oh, we're near neutral. We're near neutral. Okay, now tariffs are here. Okay, we're not cutting until we figure out. Well, the labor market forced them to, get those cuts in there. Now, possibly we could have maybe 3 all together when it's all done. But, it'll be interesting to see the composite of who the Fed voting chair is, the Lisa Cook situation and anything else and how that's going to act. But for sure next year, even starting today all the way to 2026, American households have access to sub 6% mortgage rates for the first time. So that's something that nobody's had to deal with. Remember, we had 8% mortgage rates in 2023. We had 7.25 at the highs of 2025. So we're down here. So it's a much better backdrop, and the reign of terror of Powell is coming to an end, right? So you have all these things that are a little bit different going into 2026, and especially even now going toward the end of the year. It'll be interesting to see how the housing market reacts to that.
So labor is such an important component in your, labor over inflation, and that's what you think that the Fed acts on. And yesterday you said that they talked about was it job openings or job that like 6 times?
So job openings and jobless claims are what the Federal Reserve has always used in a lot of their Fed meetings in the past.
So given that, and we don't have a jobs week next week because we won't have that report come in, what happens when we finally get the jobs numbers? Do you expect that we're going to see a big change that we just don't know about right now?
So everyone is basically saying, with the private sector data that everyone's using and the jobless claims, because the states are still using their jobless claims, we're pretty much at the same levels. Okay. But if you're even creating 50,000 jobs, Jerome Powell will be happy. He will say that's perfectly acceptable with population. They are so 100% in on the population growth, even though manufacturing jobs have been lost since 2022, even though housing permits are at recessions and construction, they still put all the weight into population growth. Well, in that case, anything 50,000 or above would technically be beating Powell's estimates, right? So we have such low job growth, we're at so low levels. It doesn't take much to move the needle again on this side, where just a little bit of hiring can make things look better. And Powell even said, hey, listen, if the jobs data got better, I'm not cutting. He was really emphasizing, I'm forced to cut because I kept on telling everybody the labor market's solid, and then this happened, and now I'm trying to make it all about population growth. But clearly, Powell does not want to cut at all, right? He was forced, and I think, he had to swallow his pride, and Beth Hammock and all those people that said the labor market's robust, and then all of a sudden this has happened. So it doesn't take much to get yields going a little bit higher if the Fed is in modestly restrictive status. This is why it is a necessity to get Powell out of this and have a new Fed chairman, because he's going to push that. He would have pushed that whole game plan all the way in 2026, the modestly restrictive policy out there.
Okay, so who would be your pick among these 5?
Same as always, I'm Team Waller, just because I trust he would do the right thing always. Part of the problem about having a Trump person in there is that if that person stays for a while and Trump's no longer president, I 100% guarantee you the person's going to go super hawkish just because of Democrats in the White House. So Trump to me still likes loyalty and he likes his own people. So a Kevin Hassett and a Warsh, I still don't know how Rick Reeder got in that mix, but those people would be Trump's people, where Christopher Waller and Michelle Bowman would be just like, still Fed people, still in the system. And one last thing, we're going into November and December. Usually in the previous decade, purchase application data, I used to wait out the second week of January to the first week of May. Traditionally, volumes always fall after May. That's the seasonal volume curve in purchase apps. Post-COVID, November and December has kind of taken some of the seasonal things. So it'll be interesting, especially if rates just come down just a little bit more, how this data acts going into 2026 if we have another seasonal pickup in November and December. The only time we actually had something like this last year, the purchase apps held up pretty well, even though rates were elevated. But you always have to be mindful of whenever you have a seasonal demand curve, you just have more people looking. So demand naturally picks up no matter where rates are at. But at the end of 2022, when rates fell towards 6%, it really gave us that November, December, and January. That was the 12-week run in purchase application data. And that gave us one of the biggest month-to-month sales reports in the history of America. It was 500,000 homes increase in 1 month. They all fell into that 1 month. So I'll be very curious to see, do we get a traditional seasonal curve where not much is happening with purchase apps going out to the rest of the year and then we start over? Or is it going to be like the last few years where November and December? We'll see, because now that rates are lower, you got to be able to, tell the difference. But it should be a very fun last 2 months of the year.
Yes, and this is the official last month of October, last day of October. Hope you have a great, happy Halloween, Logan, and I will talk to you again soon.
Everyone have a Snickers, baby, and a Baby Ruth. Goonies, it's our time now, Gen X.